So I wanted to talk about the credit cycle. So you have these credit cycles nowadays. You don't have business cycles anymore, where a business, the economy would expand and then decline and crack up, and you have a recession. Now what you have is these ultra-engineered credit booms and credit expansions, where banks and central banks issue so much debt, and they just keep issuing all this debt because they set interest rates so low, and then the debt issuance increases and increases, and so then that it exponentially expands the credit supply, the debt supply, and it gets to a point where the debt supply becomes so high that it will not be able to be serviceable. And then when the debt becomes unserviceable, interest becomes unserviceable, then you're going to have a bust in the system. It'll implode, basically. So how does this happen? Let's just look at the history. Okay, so 2000 dot-com bubble. Let's start from there. 2005, 2006. So what you had was banks, little banks and central banks lowered interest rates very low. There was predatory lending. There was all this shenanigans going on. There was a bunch of idiots on bicycles wanting to get killed, and they were just like dumping out all this debt into the system at low interest rates. And so everybody was taking these loans, taking this debt, trying to use the debt to for their own means, and maybe some people were trying to use it to invest. Some people were flipping the debt, trying to just make money off of their debt. That's called derivatives, where people they take other people's debt and trade that debt on the market. So all this debt was just getting bursted out into the system. You had mortgages that were all backed by the government, and so there was a very zero risk mortgages. All this insanity of this debt, very low interest rates, no risk debt. It was just a debt. People were like, whoa, and just having a party with all this debt, just pumping out all this debt. And then people had all this debt loads, and the economy started to decrease a little bit, slow down. And so when the economy is strong, there's a lot, people are making profits, everything is good to go, and with those profits, they can service the interest on the debt that the company borrowed. Or when companies are making profits, they can hire more people. There's jobs. People have jobs. People can pay their household debt, pay their household interest off. So it's all good to go. It's no problem. And everybody's paying off all this debt. But when the economy starts slowing down, people get laid off. Profits in companies start to decrease, so then the ability to pay off that interest becomes more and more burdensome, and basically the ability to service that debt becomes impossible. So that exacerbates the economy even worse, because then there's going to be even more of a death spiral in the economy, because more resource capital is going to pay off interest rates, and so profits are going to decrease even more. People are going to lose jobs, and then in the public sector, people don't have jobs. More and more people lose their jobs, and then they also can't service the debt. So then you start having all these massive defaults, And when there's all these defaults, then the interest rate is going to go up. So then when the interest rate goes up, the money supply, the debt supply is going to start to contract. Okay? And that is going to cause inflation. It's counterintuitive because more money out there usually, because that's inflation, and that means prices are going to go up. But in this case, because the interest rates are increased, the amount of money it takes to service the interest rates, there's going to be inflation, and that's going to blow out the economy even more. And so you just have a real quick boom, a bust. Everything is just going to get completely destroyed so fast when all this goes down. So what happens is you have this exponential increase in credit, low interest rates, and then when something happens with the economy, there's some catalyst, like a bank fails, or some sector starts to go sour, or there's a war, there's a geopolitical instability. It's like anything can happen. A small fire starts, and as soon as that happens, it can spread like wildfire, and people start defaulting. And when people start defaulting on all this debt, the interest rates start shooting up, and which is the yield on the bond. Okay, so look at the yield on the bond, look at the yield on the 10-year, look at the yield on the 5-year, look at the yield on the 30-year bonds. And all these countries right now have like 0%, like Japan, like the yield right now is starting to shoot up. You're having blowouts in the Japanese bonds. This is extremely dangerous. This is a signal. What's happening now is a signal that things are going to get really, really hairy soon. That you could start to see a massive collapse when the yields on the bonds start to blow out, start to increase. Okay, when the yield on the Treasury, the U.S. Treasury bond, the 10-year bond starts to go 3%, 3.5%, 4%. You're going to just see massive problems. Okay, this is going to be huge. That's when the collapse is going to come. Okay, so you're going to see a crack up boom when the yields start to rise, interest rates go up. You're going to see massive inflation. It's going to blast out the economy because people can't spend anymore. The whole economy is propped up by consumption, people spending. Okay, when people stop spending, then that's it. Kiss it goodbye.